What if the smallest number on your credit card bill is the most expensive choice you'll ever make? Picture a shopper, call her our traveler, who just came back from Orovale's Market Mile, carrying a $3,000 credit card balance. Her statement arrived. Minimum payment due, $45. Two terms matter here. The minimum payment is the smallest amount your card issuer accepts each month without penalizing you. The APR, annual percentage rate, is the yearly interest cost, sitting around 22.63% for U.S. cardholders as of February 2024. 20% APR divided across 12 months equals roughly 1.67% charged every single month. That's the slice the card issuer cuts from your balance each billing cycle. Apply that monthly rate to a $3,000 balance and you get $50 in interest, month one alone. Our traveler's $45 payment doesn't cover it. Her balance ticks up to $3,005. She walked backward. Card issuers set minimums based on a percentage of the outstanding balance. As your balance shrinks, even slowly, your minimum shrinks with it. That sounds like progress. It's a treadmill designed to slow your escape. How many years do you think it takes to clear a $3,000 balance, paying only the minimum each month? Run the actual numbers. It can take many years. Our traveler could have a child, watch that child graduate college, and still be standing in the borrow badlands. Over those years, the total amount paid comes to approximately $9,000, 3 times the original balance. She bought $3,000 worth of goods and paid $9,000 for the privilege. Here's a question most people never think to ask. Why would a bank set minimums so low that customers barely make progress? The answer isn't complicated. Minimum payment structures are a highly profitable feature of revolving credit. Watch what changes with one decision. If our traveler pays double the minimum, $90 a month instead of $45, her payoff timeline significantly shortens. The desert shrinks with a single deliberate choice. And the total cost with that doubled payment, instead of $9,000, she pays significantly less. That gap, nearly $5,000, is a round-trip flight to Tokyo, a used car, or a year of emergency savings, recovered by doubling one monthly number. The engine behind all of this is compound interest, running in reverse. For savers, compound interest builds wealth. On a credit card, it builds wealth for the lender. Every unpaid dollar earns interest. Next month, that interest earns interest on itself. In Orovale's geography, the borrow badlands is a circular desert. Citizens who pay only minimums walk in circles, each lap looking like progress, each one returning to the same cracked checkpoint. The loop is structural, not accidental. Here's the counterintuitive part. Paying minimums on time keeps your credit score intact. Your report shows no missed payments, but your net worth is quietly eroding. A clean credit history built on minimum payments is a polished trap. It looks fine from the outside. Every dollar sent to interest is a dollar not invested. The S&P 500 has averaged roughly 10% annual returns since 1957. $6,000 redirected into an index fund over 20 years, at that rate, grows to approximately $40,000. Card issuers calculate minimums using one of two methods: a flat floor, often $25 or $35, or 1 to 2% of the outstanding balance, whichever is greater. The floor ensures you always pay something. The percentage ensures you never pay enough. Here's where it gets harder. The average American carries 4 credit cards, according to Experian's 2023 Consumer Credit Review. If each card carries a balance, and each gets only minimum payments, the citizen isn't lost in one loop. They're running 4 simultaneous circles through the Badlands. The debt avalanche is the mathematically fastest exit from the Badlands. List all balances by interest rate, highest first. Pay minimums on everything else, then throw every extra dollar at the highest rate card. Once that's cleared, cascade to the next. The debt snowball takes a different angle. Pay the smallest balance first, regardless of rate. Research from Northwestern University's Kellogg School in 2016 found that Snowball users were more likely to eliminate all debt because small wins sustain motivation. Math and psychology are both real forces. A balance transfer card with a 0% introductory APR, commonly 12 to 21 months, can freeze the interest clock entirely. Move the $3,000 balance to a 0% card, and every dollar paid goes straight to principal. The desert stops expanding. 2 catches. Balance transfers carry a 3 to 5% transfer fee. On $3,000, that's up to $150 upfront. And if the balance isn't cleared before the promotional period ends, the rate reverts, often to 25% or higher. Remember that treadmill? A balance transfer combined with a fixed monthly payment above the minimum is the power switch. Step off, set a real pace, and the borrow Badlands finally shrinks behind you instead of stretching ahead. Clearing balances also improves credit utilization, the percentage of available credit currently in use. FICO recommends staying below 30% for a healthy score. A $3,000 balance on a $10,000 limit puts utilization at exactly 30%. As utilization drops, credit score rises. A higher score pulls down interest rates on future loans, mortgages, car loans, business credit. Escaping the Badlands doesn't just end the current pain. It lowers the cost of every financial decision made afterward. The borrow Badlands doesn't trap everyone equally. Households earning under $50,000 annually are more likely to carry revolving credit card debt than those earning over $100,000. But what about cardholders for whom $45 a month is genuinely the limit? That's a real constraint, not a character flaw. The priority shifts. Call the card issuer and request a hardship rate reduction. Card issuers often grant rate reductions when customers simply ask. Here's how the numbers shift with one phone call. Request a rate reduction, granted in the majority of cases. On a $3,000 balance, that single change can significantly lower the monthly interest charge. Now add a fixed payment of $150 monthly at that 15% rate. The payoff timeline drops to 23 months, and total interest paid falls to roughly $500, compared to $6,000 on minimum payments alone. Back to that opening question. The CFPB's own research found that cardholders who pay only minimums take significantly longer to clear their balance than those who pay a fixed amount above the minimum. The smallest number on the bill isn't a lifeline. This week, pull up your credit card statement. Find the minimum payment. Find the total balance. Then find the payoff calculator at consumerfinance.gov. Free, run by the CFPB, and it'll show you exactly how long your current path takes. That number is the first exit ramp. A $3,000 debt doesn't have to cost $9,000, but it will, every single time, if the only number you ever pay is the smallest one on the bill. Auravale doesn't hide its rules. The math is public. The formulas sit in every cardholder agreement. The citizens who escape the Badlands fastest share one habit. They calculate the true cost before they swipe, not after wandering for a decade.